If you only look at the screen right now, you see $84 silver, and you think weakness. You think the story is over. You think the vaults, the premiums, the deficit, all of it was noise, and the market has spoken. The screen is not lying. Silver is at $84. But the screen is only the surface, and the surface is where retail makes its decisions and its mistakes. Today, I'm going to take you beneath the surface, 4 layers deep. Because what's happening underneath $84 silver is not what the number suggests. And by layer 4, you're going to understand why the people watching the screen and the people watching the structure are arriving at completely opposite conclusions about Monday morning. Ken AG here. This one requires focus. Disclaimer. Education, not investment advice. I don't know your position, your risk, or your timeline. What I can give you is depth, and depth is the only thing that separates signal from noise when the screen price is screaming. Layer 1. The surface. What the screen shows. Silver closed Friday near $84, down from $93 the previous week. The chart looks damaged. Momentum broken. The narrative on financial media has shifted from rally to correction. If you're a headline reader, the story is simple. Silver went up, silver came down, move on. And at this layer, the CME just made a move that most headline readers will misinterpret. They reduced silver futures margins from 18% to 14%, a 22.2% reduction in the cost of holding a position. The surface level interpretation says this is bearish. They're making it cheaper because the market is cooling off. Or this is bullish. They're fueling the next move. Both interpretations are wrong because both assume the margin cut has a direction. It doesn't. A margin cut reduces friction. It makes it cheaper to go long and cheaper to go short. It makes it cheaper to speculate and cheaper to defend. What it does is increase the market sensitivity to whatever force gains momentum first. Think of it as lowering the activation energy for a chemical reaction. The reaction still needs a catalyst, but when the catalyst arrives, the reaction happens faster and with more violence. That's the surface. $84. Margin cut. Ambiguous. If you stop here, you make a decision based on incomplete information. Most people stop here. Layer 2. The vault. What the inventory shows. Now we go one level deeper. The COMEX inventory report for March 6th shows registered silver at approximately 81.2 million ounces. Registered is the only category that matters for delivery. It's the metal that sits behind a warrant available to fulfill a futures contract when the holder says, "I want the physical." 81 million ounces sounds like a number. Let me give it context. In October, registered stood near 167 million ounces. That's a 51% decline in less than 5 months. And the pace isn't slowing. February delivered 5,036 contracts, which is 25.18 million ounces. In a minor month, 5 to 8 times the historical average. On first notice day alone, 1,881 contracts demanded delivery in a single session. Those aren't speculators rolling paper. Those are participants who want the metal. Now pair the registered number with open interest. The primary silver futures contract, the SI, showed 151,542 contracts of open interest. Each contract represents 5,000 ounces. That's 757.7 million ounces of nominal paper against 81.2 million ounces of deliverable metal. Coverage sits at approximately 10.7%. Roughly 11 cents of metal for every dollar of paper obligation. That doesn't mean default on Monday. It doesn't mean the exchange breaks. What it means is that participant behavior matters enormously. In a market with 90% coverage, everyone can relax. Nobody worries about whether the metal is there because it obviously is. In a market with 11% coverage, trust becomes the load-bearing structure. If participants trust that most contracts will roll as usual, the system works. If a meaningful minority changes behavior and stands for delivery in a tight month, the math stops working. And the math doesn't need a majority to stop working. It needs a fraction of the open interest to exceed the registered inventory. The surface shows 84 and says weakness. Layer 2 shows 81 million ounces draining at a record pace and says the physical market is tighter than it's been in modern history. Layer 3, the premium, what the retail buyer actually pays. This is the layer that separates the theoretical from the practical. Because you don't buy abstract silver, you buy coins, bars, and rounds with a premium, a spread, and a delivery timeline. Sprott highlighted on March 5th a data point that should have dominated every silver conversation this week and barely registered. 1 ounce silver coins were being offered at $102.51 when the spot price sat at $81.89. That's a premium of 25.18%. Let me say that differently. The screen says 82, the counter says 103. The gap between those two numbers is $21. And that gap is not abstraction. That gap is the physical market telling you that the price on the screen doesn't reflect the price of actual metal in your hand. Why does this premium exist? Because physical silver has friction that paper silver doesn't. Fabrication cost, dealer margin, shipping, insurance, supply chain logistics that are currently disrupted by energy risk and geopolitical uncertainty. And most importantly, availability. When inventory at fabricators and dealers tightens, premiums widen because the next coin costs more to source, more to ship, and more to carry. The screen says $84 and suggests you're buying a discount. The retail counter says $103 and confirms you're buying into a market where physical availability commands a 25% surcharge over the number on your broker's screen. The screen price and the purchase price have diverged. And when they diverge, one of two things must happen. Either the screen catches up to the physical reality, or the physical reality retreats to match the screen. In the last 6 years, every time this divergence opened up, it was the screen that eventually caught up. Not the other way around, because you can print contracts, you can't print ounces. Layer 4, the structure. What connects the first 3 layers. This is the deepest layer, the one that most analysis never reaches because it requires holding all 3 previous layers in your mind simultaneously and asking what do they mean together. The surface says 84, the vault says 81 million ounces draining at unprecedented speed. The premium says physical cost 25% more than the screen, and the margin cut says the market just became more sensitive to whichever force wins the next session. Individually, each layer tells a partial story. Together, they tell a complete one. The story is this. We are in an environment where the screen price and the physical market are no longer saying the same thing. The screen says correction. The physical says shortage, premium. The screen says cooling. The vaults say draining. And the margin cut says that whatever happens next will happen with more leverage and more velocity than it would have last week. This structural divergence is the actual event, not 84 hours, not the margin cut, not the vault number in isolation, the divergence itself. Because when paper and physical diverge during a period of declining inventory and elevated geopolitical risk, the reconciliation, when it comes, tends to be violent. The screen doesn't gently drift toward the physical premium over weeks. It gaps, it jumps, it creates the kind of candle that people screenshot and share for years. I'm not predicting when that reconciliation happens. It could be Monday, it could be 3 months from now. What I'm telling you is that the conditions for it are present in every data layer beneath the surface. And the people who only watch the surface will be the last to know. Now, 3 signals for Monday, not predictions. Signals. Signal 1. The PSLV discount. Sprott's Physical Silver Trust currently trades at approximately negative 5.7% to net asset value. That means you can buy allocated silver at the Royal Canadian Mint at a discount to the value of the metal itself. If that discount starts closing, moving from -5 toward -4, -3, -2, the market is telling you that investors are willing to pay closer to full value for allocated physical exposure. That's a behavioral shift, and behavioral shifts in closed-end trusts during physical tightness are leading indicators, not lagging ones. Watch the PSLV discount daily. Its movement is a thermometer for the physical bid underneath the paper surface. Signal 2. Open interest after the margin cut. Margin just got cheaper. The question is what happens next. If open interest rises in the coming sessions, the cost reduction attracted or sustained more exposure. That means more contracts sitting against a shrinking registered base. The coverage ratio drops further. The sensitivity increases. If open interest declines, the market is reducing exposure despite cheaper cost, which would suggest the correction has room to deepen. The direction of open interest after a margin cut is the market's vote on whether the structure is compelling or exhausted. Signal 3. The physical retail premium. If the spot price sits at $84 and coins are still selling at $103, the divergence is alive and widening. If premiums compress toward 10 or 15%, some of the physical tightness is easing. The premium is the market's real-time report on availability, not on sentiment, not on narrative, on whether the fabricator can get the metal, turn it into a product, and deliver it at a price the buyer will accept. That process has friction, and the size of the premium tells you exactly how much friction exists in the system right now. Those three signals together, PSLV discount, open interest direction, and physical retail premium, give you a more accurate read on Monday's reality than any single candle on a chart. The candle tells you what happened. The signals tell you why. Let me close with the distinction that matters most. The surface investor looks at $84 and asks, should I be worried? The structural investor looks at 81 million ounces draining at a record pace, a 25% physical premium, a margin cut that lowers friction in a tight market, and asks, which layer am I making my decision on? Because the layer you watch determines the decision you make. And the decision you make at $84 in a market where the vaults are drying up is either the best or worst decision of your year depending on which layer informed it. The surface says one thing. The structure says another. Your job is to know which one you're listening to before the bell rings. Comment below. Tell me your exposure. Physical, SLV, PSLV, futures, or none. Because the answer to what should I do depends entirely on which layer of this market you're actually in. The stacker holding physical is in one reality. The SLV holder tracking the screen is in another. And the participant with no exposure is in a third. Each one needs different information. Each one faces different risk. And each one deserves honesty about what their position actually means at this moment in the market structure. If this video gave you depth instead of volume, hit the like button. Share this with someone who saw $84 and panicked, or someone who saw $84 and shrugged. Both need the layers beneath the number. As always, take care of yourself and each other. Your friend Ken AG. The surface shows 84, the structure shows something else entirely.